we'll get in the management of LG Electronics. We have Mr. Atul Khanna, Chief Accounts Officer at LG Electronics, who's joining us on the show as well. And with him, we have Sanjay, Chitkara, Chief Sales Officer at LG Electronics. Welcome to the show, gentlemen, and always a pleasure to speak to you both. My first question coming to you is, so far it's day one of the IPO. I know we've spoken about earlier as well in terms of how are you going to use the funds, etc. But from here on, what is the vision that LG Electronics is sitting on if you have to look at the next 3 years, taking into consideration the fundraise that you're doing, the kind of leadership that you already hold? So where from here on?
So see, this IPO will strengthen our ability to invest more in newer technologies, manufacturing and customer services, so that we can offer a better new products to our customers and a better customer experience. So in future, maybe customer can see better products and services, while our shareholders will grow with our share value. So I think this is a win-win outcome for everyone, including LG Electronics.
Sanjay Chitkara, Chief Sales Officer, is also with us. And Sanjay, it must be a good stand to take when you come out for an IPO wherein you are in the leadership category across a bunch of consumer durable products. And now with this GST cut coming in, the timing couldn't be better. How do you forecast or how do you foresee the immediacy of revenue growth for you? And then we'll, of course, talk about the longer term as well.
See, we are very excited with this GST cut, and it's a direct enabler for our business, and it has improved the affordability of the product. With this, a brand like LG is more beneficiary because we have a better opportunity to cross-sell. Because if a consumer is coming to the store with a limited budget, now he has more money to buy some other products also. So we are trying to bundle it with other products like sound bars, with TVs. Similarly, we are also getting a trend of upgrade of the product. Like consumers are upgrading their product. A 55 inch is upgrading to 65 inch. A 300-liter refrigerator is upgrading to 400 liters. So such upgradation is happening.
Yeah. Okay. Just a follow-up question to that, Sanjay. That the domestic demand looks strong. I'm still looking for what do you believe could be the kind of revenue growth that could come into sales or a volume growth that could come in. But part two of my question added to that is that most notes say that from a 6% kind of share of exports in FY25, you are possibly looking at about 10 to 15% kind of export share by FY30. So what's the domestic volume growth likely to be near term, medium term? And export growing to 15%, I'm guessing that means that domestics will grow, but exports will grow faster.
Yeah. So if we see, before coming to LG's growth strategy, India is growing. And for our TAM, which is $41 billion currently, it's growing with 14% CAGR growth, and it will become $73 billion by 2029. So there is a 14% CAGR growth, and LG would definitely try to surpass this growth rate because we have very strong growth strategies, scaling of our B2B business, service business through annual maintenance contract, and we are planning to introduce many new products and missing categories. In future, export is also a focused area. Currently, our export is 5%. Revenue terms, it is $160 million. We are exporting to Southeast Asia, Middle East, and African countries, 45 countries. So last year, over previous financial year, this year we grew by 45% in our export. But we will definitely add newer geographies for our export portfolio and new product category. Currently, our export is limiting to medium range product, that is refrigerator, washing machine, and compressor. But recently in 2023, we started manufacturing premium product in our Pune plant, like side-by-side refrigerator, OLED TV. For developed nations and major economies, the premium product consumption is more. So this will definitely open new door for exports horizon. Our current factory is near to Western Coast, this Pune plant. We have very thoughtfully chosen Sri City, which is much near to eastern coast. By this way, we have covered both the coast of India, and we have also overcome the logistic barrier.
Mr. Khanna, hi, Mahima this side. Just want to understand one thing from an accounting perspective. You correct me if I'm wrong here. You have a tax litigation of around 4,700 crore, for which my understanding is that the cash balance is enough to cover that. But just to give investors a perspective, what is this tax litigation regarding? And according to you, what are the chances of being the outcome being in your favor?
See, as you rightly mentioned, that there is a 4,700 crores of litigations which is ongoing. It includes all show cause notices as well. And these all, we should not compare the litigation worth of value with our cash balance, because in last 28 years, we never particularly paid any such demand, and we have won all our cases based on the technical and merits based from either direct tax as well as from the indirect taxes as well. So, and all these cases what are going on are also particularly we have won either at the first level of appeals or at the tribunal level. So we are not forcing any such probability of losing any such case. So we are confident that it would be all with the pace of time, it would be all diluted over a period of time.
So, Mr. Khanna, so what you're trying to say right now is that this is something which you're confident of, that you will win this litigation. There will be no tax demand which you will have to pay in terms of the 4,700 odd crores.
Right. All our cases by each year, we have a good merits cases where we can won all those litigations without any demand.
And my additional question to you is, because everyone's talking about the opportunities and everything that LG is sitting on. Another weakness that brokerages are highlighting is the dependence on promoters, specifically when it comes to royalty obligations as well. FY25, you paid around 455 odd crores. What is the outlook looking like when you talk about royalty? Do you see that reducing over time? How is that entire structure going to pan out from here on?
So we need to understand why one pay royalty, because royalty is being paid for usage of brand as well as the usage of the technical know-how and the innovative products being provided by our parent. They have all platforms. We have Indian consumer insights. We share with them, they develop the product, we test it, and then we introduce it to the market. Based on that, we are paying the royalty to our parent on domestically produced goods, and by that way we are paying our royalty rate, expense rate is 1.9% odd to our total revenue, and we are not forcing any such change, framework change in the going forward period. And changing the royalty framework is also not so easy. It depends on a lot of transfer pricing adjustments as well as tax regulations comes into the picture. So we have just settled it down, particularly 2 years back, and we are not forcing any such change in the royalty rate going forward. And we cannot call it as that it is a dependency, because parent has invested in the beginning 28 years ago, right? So particularly when they have seen that India is a market where one can invest and bring on all innovative products for the Indian consumers, and year on year we are introducing a lot of new technologies and giving them a lot of other good product, innovative products, energy efficient products. So for that only we are paying royalty to them.
I was trying the conversation earlier, just a quick follow-up. Some idea of the growth rates that you guys envisage. I mean, for an investor to put in capital into your business, some inclination or some idea of what the growth rate could be.
See, our previous CAGR growth is 10.7%. And we will definitely say, being a sales leader, I mean, it would be my best efforts, and we'll put all energy to surpass that previous CAGR growth rate. And that would be our definitely the effort. And the way the things are favorable, the GST cut, IT relief, all these things have provided a more disposable income to consumers. And lastly, our products are just basics and are very highly underpenetrated. We are not selling luxuries. and these products are needed to make daily life easy. So that demand of this our products will definitely grow, and will definitely try to surpass our previous growth rate.
Sanjay, so just before we wrap up, I must compliment you guys on the pricing, right? Because everybody's talking about how well priced the issue is. But if you're citing a 10.7% CAGR of the past, whatever, 10 years, then you are under-promising, because the last 3 years you've grown much faster. 13%, as I'm told, on the revenue side, over 20% on the PAT side. Are you telling us you will grow lower than that?
No, not at all.
Not at all, okay.
Not at all.
Because you said you will cross 10%, so hence I'm asking, yeah.
See,
So our growth rate
whatever
for
we
last
promised.
fiscal years is, yeah.
Yeah, please, Atul. Yeah.
So our growth rate, which Sanjay ji explained, is since last 3 fiscal years, our CAGR growth rate is 10.7%, right?
Okay.
And so,
Maybe our
we
numbers are
can
wrong.
surpass this number.
Okay.
Fiscal year 23 to fiscal year 25, our growth rate is 10.7% CAGR. So our endeavor as well as vision is to cross this number
Fair call.
each year.
Okay. Maybe I've erred a little bit on my math, but be that as it may, I'll take your number for it. You know your company best. So you'll grow more than what you've done, or at least try to match those numbers, which is good to know. But all the best for the IPO and the outlook ahead. Thank you so much, gentlemen, for taking the time out and being with us.
Thank you. Thank you very much.